Welcome to the Acquisition HQ podcast, where we interview seasoned operators, investors, and as well M&A service providers to help you walk through deals, to help understand how to make your potential acquisitions, and also learn more about investing. And today we're going to be speaking with Bill Kirth. He is a serial entrepreneur, investor, and partner at Rectify Partners. I'm going to read his bio here. It's an extensive one, and I'm excited again to have you on here. Bill is a hands-on investor and a board advisor with extensive experience helping small to mid-size businesses scale, optimize capital structures, and execute growth strategies. He is actively involved with his portfolio companies, often taking board seats and working closely with founders and executive teams. A recent portfolio company supported by Bill achieved a successful seven-figure exit. He also serves on the board of Boss Strategies Global, where he recently has made the acquisition of a consumer brand popcorn company called Pop Art Snacks. Bill is the founder of Rectify Capital, where he provides also flexible working capital solutions, including PO, AR financing, SaaS, and revenue-based financing, subordinated and convertible debt, and equity, bringing both capital and strategic partners to growing companies. Thanks for joining us.
Sounds more impressive than I really am.
Well, it's quite a flex. But, I wanted to have you on the podcast. And again, thank you for accepting the invitation, really to share with our audience about, debt, equity, how to create a cap stack, all the things that are really important for somebody who has a holdco that's looking to make an acquisition.
Okay.
And then also we'll touch on this exit that you just had.
Thank you.
How did you get started in the game of finance? Let's dive right down in that route.
I lost a bet. Just kidding. No, out of college, I studied accounting and finance, and my first job in college was a bank auditor. Quickly got bored with that, and I tried banking, and that lasted about a year. And I found my way to high-priced debt in the form of factoring, accounts receivable financing, kind of an earlier stage, grittier financing with more risk and more upside. Mm-hmm. And along the way, I met a company called Skullcandy. Met Jeremy and Rick early on. They just moved out of Rick's garage to their first location and needed cash desperately. Every bank in town turned them down. I liked what they did, and I gave them their first $200,000 in debt. From there, I grew them to $4 million a month and ended up getting paid off by a bank. But I made a lot of money during that time. And I felt pretty good about myself getting high-priced debt until I saw what my buddies Kent Thomas and Warnock and Hall with Mercado, what they made on the equity side when they had their IPO at about $500 million, give or take. And with that, I started studying private equity. I knew what it was, but didn't really know it well. So I really dove into that and utilized my skill set in accounting and finance and started my own equity fund as an angel investor. And I never looked back.
That's an interesting topic that you bring up. You've got debt and equity. And I'd be interested to learn a little bit more of your perspective on both. Mm-hmm. Obviously, you enjoy now equity, and you have a position of a board seat into various companies. But share with us a little bit more about the definitions, but then also when one would want debt or equity as one who owns a company.
Absolutely. And for most business owners, let me step back and start with one statement. Growth consumes cash. It's a very common misconception that if I'm profitable and I'm growing, I'm going to be fine. You're not. Mm-hmm. Even profitable companies, based on the industry, vendor terms, customer terms, growth consumes cash. So you always need to fund the growth. And in my career of doing this for 35 years, I've seen where companies die from indigestion and starvation, meaning they grew themselves into bankruptcy. So it's an incredibly important topic. And a lot of entrepreneurs have the skill set in their trade or their business, but not necessarily in finance and accounting. And so they make a lot of mistakes, one of them being premature dilution. I love equity. In the realm of financing, equity is like a lifelong marriage. Debt's like a 2-year fling. You're in, you're out, no strings attached. And the worst thing you do for your company is bring on the wrong shareholder because you're married for life and you can be miserable. I've done that before. So for business owners looking to raise, first thing you want to do is hire somebody smarter than you in this arena. So get a good fractional CFO. I do it all the time. There's not a company I'm involved with that doesn't do at least 12-month monthly forecasted financial statements. You plug in all of your data points such as revenue, gross profit margin, vendor terms, receivables terms, inventory turn, duration of manufacturing. You plug all that in, and it'll tell you when you're going to run out of cash. And the idea is to look at that and always have 12-month forecasted out there, knowing that, hey, in month 8, I'm going to run out of cash. Start plugging it today. Don't wait till you're out of cash. And it's a very important skill set that, again, a lot of business owners don't have, but you need to hire it. And so I made a career out of being the dumbest guy in the board meeting. I hire people smarter than me. And that's my goal, by the way. It's not hard to do, but it's my goal, is surround myself with people who are so much smarter than I am, who can do these things that I can't do. And then I take the same advice to business owners, because I was the guy who, with Blue Eye, I was chairman of the board and CEO for about a year. I hired somebody smarter than me to run it, gave him a good amount of shares in the company. Best decision I ever made. So I can preach that because I did that early on in my career, and it worked for me. So when I ask people to do that, they say, why'd you do that? Well, I did it.
Yeah.
So I'm not asking you to do something I didn't do myself. And by the way, it worked out amazing for me and for my buddy Damon, who ran the company, and he was in the same exit. Damon Kirchmeyer, shout out, great job.
We'll touch on that here in just a second, but before we do that, I want to make sure I ask a question here. Earlier on, you said most companies will die of indigestion, and I'd be curious, as one who's now in a seat of growing a company, and then maybe you guys out there are growing your companies, how do you know the red flags that pop up before you get to that end, where you're actually growing too fast?
Yeah.
What are some of those indicating factors that I would need to look at to make sure that I don't, that I are improactive in essence with my decisions?
Yeah. Well, number one, manage who your customers are. Now, if you're a B2C, you're fine. You get paid with a credit card, instant payment, that's fine. But as you start selling to companies, large companies, Walmart, Costco, whatever, they have different sales terms that they do. So for instance, at one of our companies, Boss Strategy Global, we have customers that are net 30, net 60, and net 90. Well, that makes a big difference. You give up net 90 terms, that means your money's out for 90 days on that side only. Now, if you take the same company and let's say this company is an importer, right? Most vendor terms internationally are 30% upon issuing a PO, 70% for import. What does that mean? For a products company, if I get a purchase order from, say, Walmart, I got to put in a PO. I got to pay 30% of that cost of goods sold right now. Then 30 days later, it's manufactured, it's at the port, I got to pay the other 70%. So my money's out right now. Then it goes on the water, then it goes to 3PL, then it goes to your customer, then they have 60 days to pay you. Your money's out 100 days. That will decimate most companies if you don't have any financing.
Don't have any financing or a very strategic or long financial forecast.
Right.
Yeah.
But with the forecast, what the forecast does is it identifies that. So you asked about what the red flags are. That's it. If I plug all these in, it's going to tell me you have no cash. You're going to be out of cash in month 2, waiting for these people to pay you, having paid your money out here. That's your red flag, are these forecasted financial statements. I don't make a single decision in a company without plugging those in, because every decision you make in a company has cash flow implications. Does that make sense?
Yep.
So if I make a decision, I plug in there, it'll say, wait a minute, guys, you make that decision, you're going to be out of cash in 3 months. So maybe alter the decision, or to your point, put together financing. So to your other question, how do you finance? I always try to do debt first and equity second, because debt, again, is a fling. It's non-dilutive. It's transactional. Even high-priced debt, if I take that high-priced debt for a year, it's only a year. But I give equity, that's forever. And so a scenario I look at a lot is that I will get debt in first, make sure the debt cash flows a company, then go for equity. Well, why would I do that? Here's a scenario. I come to you for $500,000. I want you to invest in my company. If I say, Nate, I've got this great company, but I've got to make payroll next Thursday. I'm 30 days behind on my vendors. I really need your cash to kind of keep this thing going. That's one message. Or if I say, Nate, I've got this company, we're cash flowing, vendors are paid, everything's good, I'm cash flowing, but I can take your $500,000 and 3x revenue. Which one do you think gets the money?
3x revenue.
Exactly. So don't go to an investor if you're already starving for cash. Take debt, even high-priced debt, plug it into the company, cash flow your business, be sustainable, then go for equity if you can do this, because it's a better message for your investor. But I'm not putting my money in to plug a bunch of holes and mistakes. I'm putting my money in to grow this thing, and we all grow together. Make sense?
Yeah, absolutely. I'd be curious now to talk a little bit more about, that holdco company that's wanting to make another acquisition on top of what they've already created. Can we talk about some financing options available there? Would that be considered still debt, or how would you go about doing that?
If you have a holdco, number one, I try to go for seller debt first. So someone wants to sell me a company, do they need all the cash right now? Probably not. So I'll ask them to carry the note. I'll pay them a healthy interest rate, make it worth their while, and that alleviates a lot of the problem early on. You're not pushing cash out that you need to operate into the purchase of the company. If you can do it, great. If you can't, right, well, there are SBA loans that will help you acquire a company. Of course, you can bring in partners and actually go through equity. But really, there's not a lot of options if you're acquiring a company unless you have a company that you're buying and you can leverage the assets of the company.
True. Yeah,
right?
That's good.
And so there are loans. For instance, you buy a company, and if you're buying the stock of the company, which I rarely do, but if you're doing that, you can leverage the receivables, the inventory that's already embedded in the company. Or maybe there's some assets that have been fairly depreciated. You can re-leverage those because you have hidden equity in those depreciated assets. Or as I mentioned, if you have to pay the business owner, then put in some of your own cash. But there's a combination of both, and every situation is different.
Yeah, let's talk a little bit more about that actually in some of your experiences with companies that you've acquired or that you've seen others acquire. What are some best practices in essence of making that acquisition, both from a term sheet standpoint and then also from a cultural standpoint?
Oh boy, that's a big question. Okay, from number one, from the asset, as I mentioned, you can leverage the assets. That could be a mistake also, because if you over leverage the assets to make the purchase, you have nothing left to operate the company on. So let's say that I have receivables, inventory, I leverage those assets to buy the company. Mm-hmm. Now those are gone, and I have no cash to operate the company. So you got to make
needing more cash.
Yeah, because growth consumes cash. So I got to make sure that when I'm doing that, I don't over leverage the working capital assets. Now, real estate's one thing, equipment's one thing. That's great. That's not short-term working capital. Receivables, inventory are short-term working capital, which creates the cash to grow your business on a daily basis. So that's what I'm very careful on. But once you do that, you can leverage those to grow your new acquired company. We're doing that with Pop Art. Mm-hmm. We have Boss Strategy Global with the Dubai chocolates and so on and so forth. We're going to also have the same lender start to leverage the receivables for NewCo, which is Pop Art. So that's one answer to your question,
yep.
Correct?
Yep.
Now, the other one was culturally?
Yeah, because, again, I just finished up an interview for AHQ on our biweekly educational sessions, and we were diving very deep into cultural integration.
Yeah.
And, pre-integration strategy and then post-integration strategy. What have you found to be the best case scenario of integration of cultures amongst the acquisitions that you've been a part of?
Yeah, I think number one is identifying the culture of the company being acquired ahead of time to make sure that there is a fit. Because there are situations where I walked away because it's a wrong cultural fit, and it's not even worth getting into. If it's the right cultural fit, you want to early on, meet with the employees there, those you choose to keep and those who choose to stay, and introduce them to your thoughts and your culture and give them a chance to accept it. If I shove something to you, you tend to pass away. But if I put it here and offer it to you, you're going to tend to reach out and grab it. It's the same thing. I'm not going to shove it down their throat. I'm going to invite them to look into ours and get their feedback.
Well, I'd be curious on your feedback of what are good things about culture that you've seen, that are positive, and then also some negatives from your experience.
I think first off, maybe people disagree with me, but I haven't been a big fan of gifting the right people with equity. What I've found is if I have a person who's just trading time for money every day, and that's all they're doing, they have their interest and they have my interest, and they're usually incongruent. However, once somebody is on the cap table with me, even a small amount, now our interests are aligned. We're pushing for the same goal, which is successful exit of the company. So for the key employees, I've been very generous in that, and it's done well for me.
That's good.
Other than that, I think it's just aligning your interests within the company, having the right people doing the right job, making sure these people are recognized for their effort. I've seen a lot of companies where if you're not in leadership, you're just not worth anything. And they treat their employees and subordinates like they don't matter, and which is wrong. Mm-hmm. Every person within the company is important. They deserve to be recognized, and recognition is free. It doesn't cost anything to recognize somebody.
And it's very important. I mean, as you want to create an amazing company, it's some of the intangibles that actually create that amazing company that you don't actually look at, as we are seeing with, big companies that want to make, they'll want to do a takeover of a company, and then all of a sudden that acquisition fails just because there was no integration, pre-integration strategy. Let's move into some of the ways, let's put us in your mind as an investor. You're about to make a purchase of equity in a company. Mm-hmm. Put us in your mind on what are some of the things that you're looking at that are most important.
Thank you. Yeah, it's a very important question. I think the first one is you look at both the jockey and the horse, right? It's a package deal. So in the horse, which is the company, I look for things like, innovation. Is this a new product? Is it disruptive? Why? Why would somebody buy this product over somebody else's? Is this something I'm interested in? Because I'm not a Ivy League, sophisticated, private equity trained guy. I'm a guy who got a degree in accounting and finance who kind of figured it out on my own. So what I leverage my skill set's more accounting, finance, and common sense versus the, the esoteric formulas out there. So is it a product or service I like to use myself? If I like it, chances are so does somebody else. Does it make sense to me? Okay, I'm in. What is a TAM, SAM, and SOM, right? What's the total addressable market? How much is available for this company? What are barriers to growth? What are barriers to entry? Do you have a strong IP to kind of protect whatever you're doing? There's all these things, right, that you look at. Then I look at the jockey, which is the person running the company, the CEO who founded it. And where I've lost my money is when a CEO is not self-aware. So the question I answer is the CEO self-aware? Do they know what they're good at? Do they know what they're not good at? And if they're not good at something, are they willing to get help? Where I've lost my butt on deals is when I've invested in a person who had to be the smartest person in the room, who had to touch every part of the deal. They would not acquiesce to any help, and almost every time they fail. The ones I love is when they sit down and say, hey, listen, I'm good at my thing. I'm not good at this, and this. I want your help in that. Mm-hmm. And nobody's smarter than anybody else, but people have different skill sets based on their experience. And if they're different, that's serendipitous. That's what you want. I'm good at this, you're good at this. Let's put our skill set together and let's create something that's amazing.
In your experience, what have you seen that has kind of exploded a boardroom? What are some experiences, or maybe one experience that you can maybe share, but then also what you learned through that process? And it sounded like you touched on it briefly there on, having, obviously egos and those that just, they have to be in every meeting and every aspect. What have you experienced there?
I think it's the same thing. You've got the founder who's very smart at this thing that they do.
Yep.
And in a board meeting, they bring up this idea and you're saying, okay, that's great, but did you consider the cash flow implications? Did you consider this and this and this? And I prefer a 5-person board. You've got 4 other people saying, yeah, but this and this and this. They say, yeah, but it's my company, so I'm going to do it anyways. Again, I harp on a lot. It is so important to me to have somebody who's self-aware that if they want you into the board meeting, they did it for a reason. I'm not just an empty suit saying a couple smart things in 2 hours. I've got something to share and something to help the company, and they need to listen.
Yeah.
Or I just lose interest.
Let's talk to the seasoned operator out there who's looking for a potential board member to place an individual like yourself in their seat. What should they be looking for in that? Whether it's how much equity should they give, or should they only, should they focus, or, who should they focus on, and how would they be able to recruit?
Well, number one, somebody has a different skill set than theirs. I had a buddy of mine, I won't mention names, it was a while ago, but we were talking about creating a board, and I said, what do you want? He goes, I want somebody who's like me, who's got this, who thinks has the same skill set as I do. I said, wrong. It's the last thing you want. Bring somebody in there who has different perspectives, different skill set, different experience, and somebody who will challenge you. The worst thing you have on a board is a bunch of yes men who sit there wearing their suits and shaking their head and saying a couple smart things, and that's all they do. You gain nothing from that. I want somebody who will challenge me, and if I'm on board, I'll challenge the owner. Say, okay, you said this, but what about this? And hopefully they respect me enough to listen, and I respect them enough to say something, not just shake my head yes.
Yep, that's good.
And so that's probably the most important thing that I've seen explode board meetings and ruin board meetings. And then the things you do in a board meeting. You don't just sit around and talk about how great you are. I insist on every board I'm involved with, we start or end, I don't care, with a SWOT analysis. And obviously,
strength, opportunities, or strength, weaknesses, opportunities and threats.
Yeah. And too many companies want to focus on the strengths and the opportunities. Hey, we got this and that. That's great. Let's focus on this. We got these sales. It's exciting. This is great. Okay, that's great. But what about the threats and weaknesses? Mm-hmm. You really need to focus on that too. And it's not fun to talk about in a board meeting. It's not fun to address. The most important thing you need to talk about is, okay, we've got these strengths and opportunities. What about these other two? What are we addressing? How are we fixing these other two things, which is the threats and the weaknesses?
That's good. You just went through an exit, and, one, I think it's great as one who's been on a board, and then, it's exciting for you that you've experienced that. Share with me a little bit more about the company, about what it is you've just experienced, and then also maybe life after an exit for those out there that have already exited or that they want to in the future.
Sure. Thank you. So this was interesting because this is a company that I invested in 12 years ago. I actually invested as one of the majority shareholders, and I was CEO and chairman of the board. So I ran this company. I was chairman of the board, very active. And when I bought the company, it was a train wreck. Mm-hmm. Okay. I bought the company for a very small valuation because it was circling the drain. But I saw something in the company I liked, which was really a disruptive technology and security. And so it made sense to me, and I loved it. But as I got into the company, I knew I can fix the smaller things to get it to where at least it's operational. But my experience was really not one that would take it to the next level. So I called a buddy of mine who at the time was working for a private equity fund that did a mezzanine debt. And I knew I couldn't get traditional debt. I didn't want to give up equity, but I did a thing called mezz debt, which means they gave me a loan, but because of the risk, I gave them 4% of the company in the form of warrants. And they put this friend on my board, and I've been friends with the guy for a long time. And I quickly realized that we need to find a new CEO. So he and I went to work together trying to find a CEO. And then one day I said, well, wait a minute, Damon, why don't you just run the company? You have the skill set. You're on the board anyways. So he left this private equity group and ran this company. I gave him shares of the company. And I got to a point leveraging my skill set, but I was self-aware enough to know that I needed his to get to the next level, which he did. We then, got to the next level to another buddy of mine, Justin, who ran it to almost the end. So for me, the experience was I went from chairman of the board and CEO to be a passive investor, which was hard. And I was a passive investor for 10 years. So this was going to be a 3 to 5 year exit, and it being a 12-year exit. So it took longer than I thought, but learned a lot because the company had no financing, it had no accounting. I had to do a lot to cobble together just to get this company cash flowing and to save the company, knowing that there'd be more technology built on later, which it was, to the point where we sold to Motorola in November. So it was a very good exit.
When did you realize you needed to take a step away as a CEO?
I think fairly early on. My skill set, yes, I can run a company, but I find that I do really well at the 10,000 foot level, kind of taking it, disassembling it, seeing the vision. But the day-to-day portion of it, I could do it, but my interests were elsewhere. And I knew that people have better skill sets than I do in that arena. So
there you go.
Again, like I preach, I stepped back and said, you're better at this than I am. Let's both make a lot of money together. And we did.
I think it's important, though, for you out there just to make sure that you're cognizant and self-aware, like you've said multiple times during this podcast, to, remove yourself in situations that you may not be the best at within business. The numbers never lie. And yes, there's some, interpersonal aspects of building companies. But at the end of the day, it's your bottom line. And, it's good that you make those decisions. Moving into Boss Strategies Global, you just now took a board seat in that specific arena, and you just recently had an acquisition.
Yes.
How'd you guys structure that? at any level, you can share whatever you like
Sure.
as to how you structured it, and then kind of walk us through that case study.
Yeah. So I've known Mike and Vanessa for many years. I've looked at the company many times with finance, and they are brilliant at what they do. Mike is an amazing graphic artist. He has the great packaging. This is a high-end popcorn company, right? Mm-hmm. That we're selling in different retailers. Vanessa and Mike both had great ideas on how to formulate and come up with the taste and the formulas, which is amazing. They're very creative. But we're constantly running out of cash, which is a very similar story for whatever reasons they are. So they made a decision to sell the company. We saw them. I've always liked them. Sean came across them as well and made a decision to buy the assets of the company, the trademark and so on. However, Mike and Vanessa are staying on because they have their skill set. And now, before this, and I talked to them both, they were spending time playing defense. Oh my God, how am I going to pay the bills? How am I going to pay this vendor? This customer's not paying me. And they're always chasing cash. Well, you can't play offense and defense at the same time.
So true.
But they love doing the offense, which is the graphic art and designing and selling, but they spent their time playing defense and all this other crap. So we talked about, hey, listen, we'll buy the company. Now we've got the balance sheet. Now we've got the systems. Now we've got the relationships with, retails and buyers and whatnot. You stay down and focus on what you're good at. So now they're doing what they love to do, what they're born to do, which is creative. We're handling all the crap on the back end that they hate doing that we're good at and we like doing it. So all of a sudden, everybody's excited about this new product. We should be hitting the shelves sometimes late Q1.
2026.
2026, yes. Sorry,
podcast,
yeah. Yeah, so keep an eye out for it. It's going to be a fun product.
Pop Art Snacks.
Pop Art Snacks, yes.
Well, I can't wait to
I'm
I'm
already working on new flavors too. So I'm working on Dubai chocolate flavors. So.
Next podcast, you'll have to bring a bag.
We'll bring a couple of them.
Well, yeah, I mean, it seems, there's just been a plethora of knowledge shared on the to-dos, the don'ts, the proper amounts of capital, how you go about accessing capital, making sure that you understand what to do when you're developing a board from, also making investments from this very strategic way and your exciting now future. So share with us a little bit more about where you're stepping into now. And then how can people actually get a hold of you?
Yeah, well, listen, I don't have a day job. My wife likes to introduce me as her unemployed husband. So
She probably like, I don't even know what my husband does.
But you know what? Right now, I spend my days doing what I love, which is finding really interesting companies and founders, sitting on a board, putting my effort outside the board meeting into this company and just doing what I can do to help the company out and being involved with the product or service. It's fun. I enjoy doing it. So that's what I do. I mean, I'm all over social media. My email is bill@rectify.net if you want to get a hold of me. Again, I just love looking at new companies, helping companies. I am on the board of Connect Capital. I've been a mentor on Connect Capital for many, many years. I'm involved with a couple, 3 501c3 boards, but mainly I'm on boards of companies that are for profit that are trying to create something amazing and have an amazing exit. Yeah. And that fills my days right now. And I enjoy doing it.
Well, 1, we're honored to have you here on the podcast, and 2, we're honored actually to have you as a part of the AHQ Council out here in Salt Lake City, as well as a part of the council across the whole nation. So again, thank you for that. And we look forward to continue to build with you. If you guys are curious about Acquisition Headquarters, feel free just to head over to acquisitionhq.co. We also have a large conference that is our national conference coming in Salt Lake City on March 5th and 6th for seasoned operators running companies anywhere between 2 to 50 million in EBITDA. We also have our private equity, VC, and high net worth individuals that are also attracted to what we do because we also have deal flows that is available in the room. And we have M&A service providers that will help walk you through those deals in a very intricate way, just like Bill has outlined. Right. So thank you guys. Make sure to subscribe to this channel. And if you want to hear more and have guests just like Bill on, feel free just to comment below. And we look forward to making another one for you again soon.
And if I could, been a huge fan of Nate and Lacey for many years. I've always loved your breakfast paloozas. I love the ecosystem you guys are building and the excitement around business. And by the way, I knew Sean, but I really met Sean at your breakfast palooza. So
Yeah.
Big part of my life as well, and appreciate that. And the job you guys are doing, I know it takes a lot of work to do what you guys are doing and what you're building, and I'm excited to be part of it. So thank you for that.
Thank you. Well, we'll see you guys soon. We'll see you guys again soon.
Rock on.